Her Excellency Luann Burns-Martinez, the Acting High Commissioner of Belize, ladies, gentlemen, welcome to the Geological Society, which I'm sure you'll agree is not only a wonderful place to hold this event, but also a very apt location for companies such as New World Oil and Gas to present. Before we kick off, I'd like to thank all the shareholders that are here, not only for your attendance, but also your support in the development of the company. Secondly, I'd also like to thank those of you who are not yet shareholders. And I say yet, as I hope you will be convinced after what I think you will agree later was a highly informative presentation. If you do begin to waver at any stage, please think about the refreshments that we're having after this, which I hope will revitalise you and provide you with the fuel to speak to all the representatives of the company on a more informal basis, following the conclusion of the formal section of this evening. So, to set the scene, I'd like to welcome Martin Lee to the stage, who will talk about the sector, what he and investors look for or should look for, and to provide what I'm sure will be an excellent introduction. Just for background, Martin writes about high-growth oil and gas and mining shares for his new online publication, Resources Investment Advisor, which obviously I would recommend you to have a look at, and details of which are in the appendix of the presentation. He previously covered these sectors for the Investors Chronicle, where his oil and gas and mining share tips achieved an average return of 81% over a 2-year period. Martin has also worked in corporate finance and accountancy, and he has a degree from Cambridge University. Martin, would you like to take the stage?
Thank you very much. Well, Hugo, thank you very much for that kind introduction. And good evening, everybody. The last 2 times I was at the Geological Society, I was attending events organised by Finding Petroleum. Now, these were seminars organised by oil men, mostly former BP executives, and they were put on for other oil men, investors and analysts. And the subjects covered included advanced techniques for shooting and interpreting seismic, and this included interpreting data from beneath layers of salt, and also techniques for deep water exploration. Now, as you are probably aware, both subjects remain very topical. But what really struck me from seminars such as those was just how technically challenging it can be these days to find and produce oil. Now, BP is castigated for the Macondo disaster in the Gulf of Mexico in April 2010. But few people now remember that just the previous September, BP was a hero after it drilled what was called the Tiber Discovery, also in the Gulf of Mexico. Now, this was a well drilled to, I think it was 10.6 kilometers, which, just for scale, that's deeper than into the ground than Everest is high. So I think it's quite an incredible achievement to do that. And the well also made a multi-billion barrel discovery. I think it was 5 billion barrels. Now, what I find particularly astonishing is that oil men can control something the size of a small dinner plate down to such depths where you have such incredible, mind-boggling temperature and pressure, and they control direction of the drill bit as well. And then at the end of this pipe, they find oil. I mean, it seems absolutely astonishing what people can do in the industry these days. But leaving aside just how technical the industry is getting, what this is all telling me is that oil and gas is getting harder and much more expensive to discover and to produce. There are very few places around on the planet these days where you can drill a relatively shallow and therefore cheap onshore well and have lots of oil gushing to the surface. Instead, oil explorers increasingly have to go to more remote locations, which are technically and politically challenging. Wells, as I've said, also often have to be drilled to very great depths, often through thick layers of salt, which can be good news and bad news. Now, salt, as you may know, acts as a very effective seal, so it stops oil from seeping away, which is good news. The bad news is that salt makes seismic imaging very difficult, which can make it very difficult to work out where you want to drill your well. And also mechanically, drilling through salt can be quite challenging as well. So, Why is the industry going to such lengths to explore for oil? Quite simply, it's the world. The world has an insatiable demand for energy, and it doesn't look as if that's going to disappear anytime soon. We can look around at the moment and look at negative factors such as the Eurozone debt crisis or slowing growth in emerging Asian economies. But despite all of the challenges, we're not seeing energy demand falling off a cliff. And also, while there's demand for cleaner, more sustainable forms of energy, which I think is fairly reasonable, it's highly unlikely that demand for oil and gas, and for that matter, coal, is going to disappear. And in fact, fossil fuels are very probably going to remain an integral part of the global energy mix for years, if not decades to come. However, despite that demand, we've got to look on the other side for the oil industry's ability to satisfy that demand. And as we've seen, it's getting harder and more expensive to find oil. Existing oil fields are maturing and depleting. And oilmen have been telling us for years that the easy oil has been found. And by the way, this, I believe, extends way beyond just oil to many other commodities. And all of this bodes very well for oil and gas and mining companies around the globe. So let's take a look at the investment opportunity that these trends create. Obviously, with oil and gas becoming more expensive, companies that are good at finding and producing oil are naturally going to flourish. Now, obviously, it's dangerous to try and predict what the oil price is going to do, so I'm definitely not going to do that. But I speak to a lot of people who know much more about oil price forecasts than I ever will do. And I've not met anybody who will say that oil can reasonably be expected to trade again at $30 to $40 for any extended period of time. In fact, the consensus is much closer to $70 to $80 a barrel as the new 30 to 40. I think it's fair to say that the world has moved to a structurally higher commodity price environment. So given all the evidence that oil is likely to remain a high-value commodity for some time to come, oil producers rightly attract a lot of investment attention. However, from my perspective, having covered the oil and gas sector, oil explorers are often in even greater demand. And it's not difficult to see why explorers are attractive. You only have to look at a number of small-cap companies that have made discoveries or announced other significant share price triggers and you can see what that does to their share prices. For example, look at Gulf Keystone after it made the Shaikan discovery in Kurdistan, or Rockhopper exploration after it struck oil in the Falklands with the Sea Lion well. And it doesn't have to be a new discovery either. You can look at Excite Energy in the North Sea after it produced a favourable flow rate from the Bentley field, as I said, in the North Sea. And more recently, you've got Cove Energy making lots of discoveries in East Africa. But clearly, it's very important you pick the right company. There are a whole host of companies in the sector. Not all of them are going to do well. In fact, most of them won't do. I think that's a statistical reality. So when I look at oil and gas companies, there are two main factors that I look for. Now, clearly, there are numbers of different approaches, but the two things I look for are, firstly, undervalued potential relative to what the company can realistically achieve. Now, by realistically achieve, I'm talking about either reserves, which is the normal case, although in some cases it can also be production. So that's point number one. And the second point is near-term news flow to trigger the share price. When I started looking at small-cap companies, I never understood why news flow was important. But it's actually one of the most important factors that can trigger share prices. And I take two examples of companies to illustrate this. These are Ferro Petroleum and Valiant Petroleum, both of which operate fairly close to the UK. But they've got different models of exploration. So Fairrow Petroleum, on the one hand, has tended over its history to maintain slightly smaller stakes in projects, 5, 10, 15. More recently, the following successes, it's been able to increase its stake size. But its strategy has been to maintain smaller stakes, which allows it to drill more often, and therefore it's regularly in the news. By contrast, Valiant has taken an opposite approach, where it prefers to keep a larger stake of projects. But what that means is that due to the constraints of financing, it drills less often. And I think you can see the results in when the two companies come to announce news to the market. Fairrow can drill, in fact it has, I think just the other day, drilled a well which was not successful. But the share price barely moved. I think it came down 2 or 3%. But I think that's because it can turn around to its shareholders and say, quite justifiably, it's got 2 more wells currently drilling as well. So the fact that one of them hasn't worked out, it's got plenty of news flow to continue to drive the share price. That's not always the case with a lot of other companies. So just bear in mind it's very important to have news flow for the share price to respond. Now, striking oil and gas is clearly one of the major news items that a company can announce. But that's only one item. Successful explorers tend to go through a number of steps, each of which can and should increase value. Now, the first of these, or the earlier stages, are things such as licensing, which are hopefully companies getting prospective licenses close to producing fields or known accumulations. Companies securing financing. It's a sad fact that a lot of exploration is funded for by equity, and if markets are in a nosedive, there's not very much a company can do about it. So even if you're a good company, to an extent you need a little bit of luck on your side, so that when you come to have to raise finance, the markets aren't slammed closed in your face. Then there's seismic imaging. Companies such as Tower Resources create a lot of value through their seismic work. Now, although the first well wasn't a success, there is still plenty of potential in that business, and a lot of that, as I said, was driven by seismic results. Next one is farm-out deals, which is one of my favourites. This is where an oil junior does a deal with a much larger company, which has the resources to fund exploration work. So it can fund seismic work, it can fund drilling work. And in the best cases, you can do a very simple, the terms of the farm-out deal allow you to do a very simple calculation of value. And as I said, in the best cases, that can actually underpin the entire share price of a company. So it's a wonderful piece of news flow when it comes. Rig contracts can be a share trigger as well, particularly if rigs are difficult to source. And obviously you've got drilling, hopefully finding oil and gas. You've got flow tests showing how commercial the discovery might be. And you've got resource and reserve upgrades, which also clearly demonstrate a lot of value. So those are the main items of news flow that I look for when appraising oil and gas juniors. So, just to tie this all up then, I mean, we've looked at the opportunity and examined some of the main clues to look for when assessing oil explorers. I just want to take a step back and just examine the major force that's driving all of these trends. And that, of course, is urbanization of the developing world. Now, as I'm sure you're all aware, urbanization at the moment is driven by China. And there's India probably next in line, about 10, 15 years behind maybe. Then behind that, you've got Southeast Asia, South America, and Africa. Now, the key point is that urbanization is hugely energy intensive and consumes vast amounts of materials. And there's fascinating data from the World Bank which shows the level of urbanization of different countries. I think this was data taken from 2011. But it showed that what we think of as the really advanced developed countries, the USA, Western Europe, they are something like 80-odd% urbanized. Japan was 67% urbanized, Korea 83% as well. China in 2011 was 48% urbanized. that is the same level that I understand Japan was in the 1960s and Korea was in the 1970s. And I think Western Europe, the stat goes so far back, I'm not even sure where it was, but I think Western Europe achieved that back in the 1920s. So if you just ignore other countries in the chain and just look at China, there's a strong argument to say that China still has many, many years of urbanization left in its economy. And by all accounts, this is a huge force that's all but unstoppable. I mean, China is a very aspirational society. People want to better themselves. They want their children to have better lives than they have. And people have TVs nowadays, global TV services. So you can see what is possible in life. So people want better things. So it's very difficult to envisage, short of a total global meltdown, how this urbanization trend is going to stop. But if you take this to its logical conclusion, this emerging market demand for natural resources is tantamount to industrial revolution, but industrial revolution on a scale that the world has never before seen. And this is driving a boom in commodities that I believe has also never been seen and might never be seen again. Thank you very much.